Most beginner investors focus on picking the right ETF,
finding the best broker,
or chasing the highest return.
but almost nobody talks about one thing that quietly destroys long-term wealth.
Taxes.
And if you live in Europe, there's a very high chance you're investing inefficiently without even realizing it.
Because two people can invest in almost the exact same ETF and still end up with completely different results over the long term.
Not because one picked better companies, but because one structure compounds much more efficiently.
And this is exactly why accumulating ETFs became so popular among long-term European investors. So in this video, I'll explain what accumulating ETFs actually are, how they differ from distributing ETFs, why taxes matter much more than most beginners think, and whether accumulating ETFs are actually the smarter option in Europe. Let's start simple. The biggest mistake beginner investors make is only focusing on returns. But investing is not just about how much money you make. It's also about how much money you keep. Because every time taxes interrupt compounding, your portfolio grows less efficiently over time. And most people completely underestimate how powerful this effect becomes over 10, 20, or 30 years, especially in Europe, because small differences repeated consistently for decades can become massive. Most people think all ETFs work the same way, but they don't. Some ETFs are called distributing ETFs. That means when the companies inside the ETF pay dividends, the ETF sends that cash directly to your brokerage account. You actually receive the money, but accumulating ETFs work differently. Instead of paying you the dividends, the ETF automatically reinvests them internally. You never actually receive the cash directly, which means your investment continues compounding automatically in the background. And honestly, for long-term investors, this is also much simpler because reinvestment happens automatically. You don't need to manually reinvest dividends, decide where to allocate the cash, or potentially pay extra transaction fees every time. The ETF quietly compounds on its own, and over decades, that simplicity becomes surprisingly powerful. At first glance, the difference between these two approaches may seem small on a yearly basis, but over decades, compound interest turns small differences into massive gaps. Historically, the US stock market returned around 10% per year with dividends reinvested. Without reinvesting dividends, long-term returns were dramatically lower. And at first, the difference between 10% and 6% may not sound life-changing, but look at what happens over time. If you had invested just 100 euros 100 years ago and kept reinvesting every dividend, you could have ended up with more than 2 million euros. Know that no one will invest for 100 years, but the goal here is to show you why compounding matters so much. But without reinvesting dividends, that same 100 euro would have grown to only around 56,000 euro. Same market, same companies, same economy. The only real difference was this. One investor kept the compounding machine running, while the other kept interrupting it. And that's exactly why accumulating ETFs matter so much. They automatically reinvest dividends internally, keeping more money compounding for longer. No manual reinvesting, no cash sitting idle, no temptation to spend the dividends, just continuous compounding for decades. And honestly, this is one of the biggest lessons in investing. Wealth is often built through tiny advantages repeated consistently for decades, not through one massive decision. One of the most powerful concepts in investing is tax deferral, because every euro that stays invested continues compounding, but every euro lost to taxes stops compounding forever. And over 20 or 30 years, that creates a surprisingly large gap. This is why many long-term European investors prefer accumulating ETFs during the wealth-building phase of life, not because they hate dividends, but because they want maximum compounding efficiency. And honestly, most people only realize how powerful compounding is after many years. Because in investing, the biggest advantages are usually invisible at the beginning. This is also why time matters so much in investing, because compounding needs time to become powerful. The best time to start investing was probably years ago. The second best time is today, because the earlier you start, the longer your money has to quietly compound in the background. And over decades, that changes everything. compounding. And by the way, when researching ETFs, you'll often see small labels like ACC or DIST. ACC means accumulating. DIST means distributing.
And understanding this tiny difference may completely change how your portfolio compounds over time.
Which is kind of crazy, because many beginner investors buy ETFs without even realizing what those labels mean. By the way, if you want to check whether an ETF is accumulating or distributing, one of the best websites for European investors is Just ETF. You can easily check the ETF structure, dividend policy, historical performance, fees, and whether the ETF is ACC or DIST. And honestly, understanding these small details early on can save you a lot of mistakes later. Interestingly, many beginner investors initially prefer distributing ETFs because receiving dividends feels motivating. You see money entering your account, and psychologically, that feels rewarding. It creates the feeling that your investments are working. But over time, many investors realize they either forget to reinvest the cash, leave the money sitting idle, or simply spend it, which quietly reduces long-term compounding. And this is one of the biggest reasons accumulating ETFs became so popular among long-term investors, because they remove human emotion from the reinvesting process. The compounding just keeps happening automatically in the background. The question you should be asking right now is, are accumulating ETFs always better? And the answer is no. This is important because finance on the internet loves absolute answers. But real investing is much more nuanced than that. Distributing ETFs are not bad. They simply serve different goals. For example, if your goal is generating monthly income, living off investments, or funding retirement, distributing ETFs may actually make much more sense because cash flow becomes extremely valuable later in life. But if you're still building wealth, investing long-term, and focused on maximum efficiency, accumulating ETFs are often one of the smartest structures available in Europe. Personally, if I was building wealth from zero in Europe today, I would probably focus heavily on broad accumulating ETFs during my early years. Because right now, my biggest goal would probably be accumulation, compounding, and long-term efficiency, not generating passive income immediately. But later in life, I would probably start shifting part of the portfolio toward income-producing assets and cash flow. Because investing strategies should evolve with your life, not stay frozen forever. The biggest investing advantages are usually invisible, and tax efficiency is one of them. Because wealth is rarely built through one massive decision. It's usually built through small advantages repeated consistently for decades. A little less tax, a little more compounding, a little less friction. And over time, those tiny differences can become enormous, especially in Europe. So if you live in Europe, understanding how accumulating ETFs work may quietly become one of the smartest financial decisions you make early on. And honestly, that's exactly why most experienced European investors eventually start paying attention to structure, not just returns.